Hi there, traders. Welcome. Thanks for taking the time to join me. Hopefully you can all hear me and see me okay. You're joining me today from a very sunny, very lovely day in London, and I do appreciate you taking the time to be here. I'd also like to start this call, as I always do with my quarterly conference calls, by just saying that I do really appreciate you guys as copying me. It really is a responsibility to look after your funds, and I really do endeavour and continue to endeavour to grow your funds wherever possible. So once again, thank you. I take that responsibility very seriously. And hopefully throughout the course of this presentation, you'll get a better idea of exactly how I'm intending to do that and some of the market conditions that we're operating within at the moment as well. So you can see the agenda there. We're going to loosely follow that. Some background information from me, my, interpretation of the market as it stands, the portfolio, the strategy, and then what we're looking forward to in terms of the rest of the year and maybe beyond as well. Ideally with this one, with this quarterly call, I want to leave as much time as possible for questions and answers. So hopefully that's the predominant time that we use within this call itself. So without further ado, and for those that have joined previous quarterly calls, there will be some familiar slides, but there are also a few that I've sort of switched up and changed as well. So a little bit about me, from start to finish. Always good fun talking about yourself. You'll notice there that I went to the University of Exeter in the UK. I studied business and management there, and actually did a 4-year course where one of those years was a year in industry and a year-long internship. I did that with Deloitte. I joined their technology consulting practice, and within that role there at Deloitte, and equally at Deloitte Digital as well, you can see a little bit further down that track. I worked with a number of clients across a number of industries. But my main focus really was within financial services, building, designing, and implementing websites and apps for the likes of Barclays, Deutsche Bank, HSBC, as you can see. In that little gap, I did take some time off. I spent a lot of time traveling around Southeast Asia, but spent the majority of that time in Cambodia. And then equally back in late 2017, I think it was, I decided to leave Deloitte Digital, spend some more time traveling, but also focus on eToro full time. And that took the form of initially traveling around Southeast Asia, but then buying an old motorhome in Canada and driving from Canada to Panama and back over the course of about 15 months or so. After that, then ended up at Give Clarity, as you can see there. Give Clarity are a small startup social enterprise. And what we do there is implement Salesforce technology for non-profit organizations. So you can see some of my clients there. Some are current clients, some I've done projects for previously, but the United Nations Refugee Agency, the International Rescue Committee, Guide Dogs, Mary's Meals, to name a few. I did start at Give Clarity doing 4 days a week. I've now actually gone down to 3 days a week. So I'm doing that and balancing that more with eToro. So more time on the investments, more time studying, more time learning, and more time, hopefully, growing the portfolio. In terms of education and credentials, you can see the little box in the bottom left there. I mentioned university. I have some certifications with Salesforce, the British Computer Society, and the Scrum Alliance as well, who look after project management certifications. I'm in the midst of studying at the moment, as I mentioned, for the certification in advanced international wealth management with the Chartered Institute for Securities and Investments. And I should have passed that by October this year. And then equally as well, as I mentioned last time, as some of you will have seen, Time Person of the Year 2006 and Nobel Peace Prize winner 2012. That's worth looking up because that is actually technically true on a technicality. Another thing worth mentioning, actually, I did an interview recently and found out today that an article has been published on Forbes, in Forbes Spain, which talks about my, interpretation of and approach to investment as a futurist investor. So I'll be posting that relatively soon, but yeah, featured in Forbes today, which is a little bit exciting. So just to break down my stats, all of this is available on my stats page on eToro. Equally within the fact sheet that eToro produces for elite popular investors and above. So I've literally just grabbed some of the statistics there, but I want to give you a flavor of some of the, the qualitative things around that. So 11,000 or over 11,000 copiers and 11 million AUM. Those gains of 1,300% are since May 2016, and are actually closer to 1,400%. And then at the moment, currently tracking at over 85,000 followers. Some high-level statistics, so annualized return of close to 70%, 72% winning months. The Sharpe ratio there's an interesting one, the 1.62. And then equally as well, you can see my standard deviation on a monthly basis of about 10% as well. The statistics there in the bottom left show my total time on eToro. As you can see, solid start, ridiculous year in 2017. Cryptocurrencies in a strong tech market. 2018, a rebalancing, I guess. And I mentioned this previously as well, actually, though, but that 2018 result, I'm quite proud of, because going into the start of that year, I had a really, really heavy exposure to cryptocurrencies. And of course, as you're aware, during 2018, they really did tank. So having to quite quickly adapt the portfolio and move away from that, I'm actually quite happy with settling on a 3.9% loss there, particularly comparative to other investors who are invested in very similar assets at that time. Of course, I don't intend to make losses on any subsequent year, and I'm not striving towards that. But you can see in 2019 a return to a relatively strong growth. 2020 was very strong. And then we started the year, this year, really strong, actually, in January and the start of Feb. But then it's kind of tapered since then and has stuttered a bit, which I want to talk about in a reasonable amount of detail on this call. And then also really looking forward to answering your questions on that topic as well. The last thing I want to highlight here is the drawdown statistics. So I don't want to shy away from these, particularly recently and particularly since Feb. What these represent are, over the last 12 months, if you'd copied me at any given point, what's the most you could have lost? So on a particular day, the most you could have lost, for example, was 3.47%. Across the full year, if you happen to copy it the wrong time, minus 14.9%. So that shows how this portfolio can move. It shows that there are potential for losses, but it also should give you a good gauge of, when you look at the results next to that, the growth, sort of the stagger that we get as we go up. So the profit, and then equally those drawdowns as well. So as I mentioned, I do want to address the performance this year particularly. We started really strong, and it always kind of happens a bit on eToro, I think, whereby popular investors, there'll be a real growth momentum, and they'll get lots of copiers. And then, of course, if you see lots of growth in a very short space of time, there's always some sort of reconciliation there, and some rebalancing. So as I took on lots of new copiers in Feb, and at the tail end of Jan as well, we then started to see this inflation fears, I guess, is the main factor, but amongst other things, this minor correction of sorts. And as you can see, that the market's been really hesitant since. It really has kind of stop-started. At multiple occasions, I've thought, this is it, we're back to winning ways, and then 2 steps forward, 1 step back. And that's been the case for the last few months. So there's so many factors at play here that are pulling the markets in different directions. We have really strong earnings, but at the same time, there are those fears, as there should be on a macro level, associated with the potential for inflation, the uncertainty coming out of the pandemic, equally as well, US-China relations, lots and lots going on. And you can see that hesitancy there March through to June on this chart. I should highlight that what this chart does show is that if you had copied at the start of the year with $10,000, as of this morning, you would now have $11,215. I know that, as I mentioned, because a lot of people copied in mid-Feb, that is a slightly different story. But as always, and this really is my headline statement and always my message, patience. Patience will be rewarded, and the portfolio will return to growth in time. I have confidence in that. I've seen it happen over the last 5 years I've been with eToro. So yeah, I mean, give it some time. It will come back. There will be some more bumps in the road, but we are working back towards growth. And I think we're starting to learn more and more about the markets as we come out of the pandemic, and as we start to really realize the growth that lots of people have speculated about. So this is a familiar slide for some. I just wanted to touch on this one relatively quickly, but this is, in a nutshell, how I approach my investment. So it's very much thematic, in that I pick themes at a very high level, whether that's genetic engineering, nanotechnology, which is one that I'm hoping to research a bit more soon, the cannabis industry, whatever else, social media, whatever else it might be. I start at that level and then slowly drill down and drill down and drill down to the point of investment. And there's quite a few areas I touch upon in here, but fundamentally, once I've identified what I think is going to be a growth area, whether that's a whole industry, a subsector, a particular technology that might be disruptive, I then immediately set about trying to discover which companies are placed to benefit from that. Once I identify those, I'll check them out on their website, social media, news stories, and you can get a lot from those three sources alone. So how a company presents itself from a marketing perspective really can tell you where they want to draw your attention to, what they see as important, how they want to attract investors. So reading around the edges of these companies and not just the numbers is just as important as doing the quantitative research itself. Where possible, as you can see there, I also try to do as much product research as possible. If I can get my hands on products, I definitely will do. And then at that point, I'm starting to whittle it down and filter down to what I think are probably going to be some of the market leaders. And at that point, I start to do some higher level technical analysis. So looking at revenues, charts, price earnings, all of the relatively standard technical analysis that you can find, a lot of which is on eToro actually, if you go to the stats tab within a particular asset. And then beyond that, you need to make it relative. And that's where I start to look at competitors and I start to see, within this market, how competitive is it? Who are the big competitors? What are they doing differently? Are there any unique selling points to distinguish them? All of those sorts of things. I get the majority of my information on particular companies from annual reports, though. That's definitely my go-to. A lot of the time, these are regulatory, and they have to push out numbers that they can't lie about. They can't window dress at all. Of course, they try to. And if you read executive summaries, if you read through annual reports, they'll always be quite glossy when, in fact, they might be masking some other bigger issues. So one of the main sections I like to read is the risks, where companies identify the risks associated with their shares. And you can really glean a lot of information from that. Equally as well, it is worth, I think, if you're seriously investing or seriously considering investing in a company, comparing annual reports side by side. So take last year's, take this year's, take the years before, see how the tone starts to change, see if there is increasing optimism, see if there's a plateau of optimism, and you can start to make that all a bit more relative and understand the trajectory of that company. Once I have got to a situation where I've looked through the annual reports, I'm either investing at that time or potentially just tracking that particular asset for the time being. And by tracking, I mean following it, adding it to a watch list on eToro, following the company on social media, signing up for email alerts so that I'm aware of any big news stories that come through, but slowly starting to build a wider picture of a company, probably and usually before an actual investment. So that's kind of my approach at a very high level. And what does that mean? How does that translate into what the portfolio actually looks like? So this is taken as of this morning in terms of the breakdown of the portfolio. You can see that it is tech heavy. I've split out there, and maybe I shouldn't have done, but split out tech, Chinese tech, and cybersecurity. Equally, you might even roll cryptos into the technology sphere as well. You can see that really is the dominant theme within my portfolio. We are heavily exposed to tech, but equally, that's where I operate. That's my niche. That's the market I understand. That's where I think I have a competitive advantage. And so that's where I will largely invest. I'm definitely not against the idea of investing in other sectors, as you can see with cannabis, lifestyle, solar being there, maybe more in the future as part of a diversification strategy, but equally, just if there are high growth areas that do sit outside tech, I'm not going to be close to those. But tech definitely is the focus, and that's been tricky for the last few months. And I think eToro generally is quite tech focused, lots of crypto trading, lots of technology companies. So across the board, you'll have seen lots of popular investors and lots of users struggling to deal with the markets at the moment, some more so than others. And it is challenging. It is a really difficult market condition out there at the moment, which makes it exciting, but also a little bit daunting. But there's equally plenty of opportunities there as well. There's a few principles I want to touch upon as well. So at the moment, my risk score is at 5. Ideally, I want to bring that down to 4. I want to make sure that where there is growth, it's steady, and when there is volatility, we smooth that curve. But I do hover around 4 or 5 and try to get that down where I can. I don't trade a lot. I'm an investor. I'm not a day trader. I'll hedge where I think it's appropriate and when there's uncertainty in the markets particularly. And where possible, I'll try and diversify as well. So diversification isn't abstaining from profits. It's not, I mentioned this word the other day, diversification. It's just another way of investing, the way you can get equal returns with less risk. So I'm always looking for opportunities to diversify. And the last little point there is just avoiding leverage too. So if I avoid leverage, you also don't use leverage, you save on fees, which is definitely a bonus. There definitely are situations as well, though, where leverage could be useful, so I won't rule that out completely. But for now, I haven't used leverage in a while, and I have no intention of doing so. I've been giving some more thought to the best way to articulate what happens when things go wrong. I think it's very easy to kind of gloss over that, but it's become more apparent in the last few months, more necessary. And who knows which way this market's going to go. So I want to feel prepared, and I want to try and make the articulation of that as simple as possible for you guys, so you understand how the portfolio will react in those situations. So I came up with a 4-step defensive plan, which, yeah, I don't know, maybe it needs renaming. But always my first reaction when I see negative news is to hold my positions. I really don't see much value in making knee-jerk decisions and being really reactive to market news. The companies and the assets that I invest in are with a really long-term mindset. So I think in 10 years' time, these companies are going to be in a really strong position. That might seem like a long period to look at, but that's how I think, and that's how the portfolio is geared. So hopefully those that are copying are here for the long-term journey. I'm not saying 10 years. I'm hoping to realize good profits within a year to 3 years. But always, I come back to this point a lot. I think it's better to hold and to see the market play out rather than trying to beat the markets around the edges when things do get a bit volatile. If things do start to get sustained and start to come down unexpectedly or in a way that concerns me slightly, that's when I'll start to increase the hedges within the portfolio. And you can see a big section of that pie chart there is for risk management. A lot of that is hedges. And what I mean by that is basically investing in assets that are inversely correlated to the rest of the portfolio. Examples of that are me shorting QQQ, which basically tracks the NASDAQ exchange, and then, or the NASDAQ 100 indices, I should say, or index. And then equally the CQQQ, which tracks Chinese technology companies as well. So by shorting those companies, what I'm doing is if there are big losses, they will obviously make profits, and that loss will be a smoother curve than the cliff edge that we might otherwise experience. So at the moment, there's a reasonable degree of hedges in my portfolio. I think we're still in relatively uncertain territory, and I'm not ready to release the portfolio and unshackle it to be exposed to that potential growth, but equal potential losses as well. If things do continue to get worse, I'll then start closing positions, free up some cash, remove those risky assets from the portfolio. And if we are looking at recession, depression territory, then I'll start to rotate stocks away and look into other areas of investment. So that really is sort of towards the bottom of the list, but equally not something that I would shy away from either. So this is actually my final slide, then we'll get to questions and answers, but I want to talk around this a fair bit. There's lots going on in the market at the moment. We really are in unprecedented territory. We've never come out of a pandemic like this before on the back of huge stimulus, with rising tensions between particular countries. We don't really know how to react to this. You have central banks all over the world who are kind of looking over their shoulders and seeing what others are doing. And that uncertainty is very apparent in the markets itself. The Fed, who a lot of people go to as the source for these sorts of macro factors, have put out lots of interesting broadcasts, basically to say that they think that the inflation that is coming, which is coming, I think we're getting inflation data on Thursday, but the inflation that is coming is transitory, i.e. they don't think it will last. It will be a rebound, and it will be anomalous data because it's going to be compared to last year on year. And so they don't expect that to be sustained. I agree with that, I think, but I am cautious. I'm wary that we are really headed into uncharted territory. So it's really good, I think, to have an awareness of that and to have a strategy to move from that as well. And that strategy, as I kind of explained, would be reducing the risk, neutralizing volatility, and then maybe rotating the portfolio away into other sectors that can capitalize on that particular trend better. On top of that, we have a few other factors too. So coming out of the pandemic, you can see the Economist article there. We're facing labor shortages. Well, in the US at least, this particular news arose relatively recently, whereby we haven't seen people returning to work as quickly as we expected. Biden at the same time is trying to push through $6 trillion worth of spending plans. And all of this combined, again, is clearly us trying to kickstart the economy and make sure we smooth that transition back. But it's very important we don't overheat the markets as well. And that's why I think a lot of investors and a lot of analysts are a little bit tentative at the moment, because we just don't know exactly how that's going to go. I mentioned before as well, US-Chinese relations are definitely the most important relations on a geopolitical scale. They're the two big powers, with China in the ascendancy, of course. So it's going to be interesting to see how Biden deals with that in the coming years. Equally as well, keeping an eye on President Xi and his announcements in terms of how China intend to interact with the rest of the world too. Finally, news from the weekend. So the BBC article at the bottom there. You may have seen this, but at a G7 conference, rich nations have agreed to back a deal that taxes multinationals. So essentially setting a minimum global tax level, or trying to, with the G7 that were present. And then equally as well, trying to do more to tax these multinationals at source. This is, in my opinion, really good news for humanity, but at the same time, not necessarily the best news for the portfolio, because what we'll see is more taxes being levied on some of the companies that we're invested in. You have big companies like Apple, Google, Facebook, who really are fundamentally avoiding taxes. But what I think we'll see, and I don't think there's been a huge reaction in the market in the last couple of days, is that this is largely already priced into a lot of those companies. I think it's inevitable, and I think a lot of people believe it to be so, that an increase in tax and probably in regulation of some of these big tech companies was coming. And this is one step towards that. So yeah, good news as a whole, but another one to keep an eye on, because news like that can definitely have an impact on the portfolio. So where does this leave us? What does all of this mean? It's difficult to say, of course. There is optimism in the markets, I think, with the stimulus that we've seen over the last year throughout the pandemic. Clearly, there's a lot of money, and there's a lot of money that needs spending. We've seen lots of strange goings on in the last few months or so, with meme stocks coming to the fore, with Dogecoin and GameStop and others, and retail investors really getting involved in the market in a big way, in what seems to be a bit of a new thing as well, and quite exciting too, to see retail investors really going for it. On top of that as well, of course, with all this information you can see in the articles you can see on this page, there's so many other big factors at play that make it very difficult to predict exactly where we're going. What seems to be the most common topic is, of course, inflation and the fears of inflation. And that's probably the one that's going to have the biggest effect on the portfolio. But at the same time, you'd expect that the Fed, the MPC, central banks around the world are well aware of this and will do what they can to make sure that there is sustainable growth across these economies. So plenty going on. It is quite exciting. It is also a little bit nervy too, because we just don't know how this is all going to play out. But at the same time, and at a very high level, I remain bullish. I think that we are going to see growth for the rest of this year. I think there will be setbacks. I think there will be some volatility there. But at the same time, when we looked at earnings, particularly the last bout of earnings, there's some really strong numbers coming out. And there's always the question really of, is that a bounce from the pandemic? Are we seeing these big firms doing way better because of changes from the pandemic? Or is that sustained and going to continue to grow in the future? I think it's more in the latter part. I think that the pandemic has just expedited and sped up that transition to faster growth in these areas. But we'll have to wait and see how that pans out in the next few months or so. So that brings me to the end of my slides. I'm very happy to interact with you guys across eToro and LinkedIn. I don't check LinkedIn as much, but we'll always try and respond to messages I get there. To get the quickest response in eToro, I suggest leaving a comment on my pinned post, but also, of course, read through my bio, my FAQs, and make sure you've taken a look there first.